But general is they all want you to be at about a 44% TDS. So why is this scale up program is exciting is because it takes that all away. They don't care about your personal TDS.
Okay.
A DCR program more looks at the rental portfolio as a qualification. Does your portfolio cash flow as a whole? And if it does, they don't care about your debt service. They're looking at a DCR.
All right, guys, ready to rock and roll. Dan Patton in the house. How you doing?
In the house. I'm doing great.
Yeah?
Thank you. Thank you for having me.
Quinton Cordick.
Yes, sir. Let's do it up with Mr. Patton over here today.
Yes, lots of stuff happening in the mortgage world. And man, it's been an interesting ride over the last would almost say like 5 years. It's been interesting from the peak to we're going down and maybe this valley. It's been a ride.
Yeah, I would say 2020 to 2025, we saw in my 20-year career, we saw sort of the highest of highs and the lowest of lows. We saw the highest of rates in a sense, and we saw the lowest of rates that we've seen. So that's going to lead to a lot of deals up front when the rates were low, and then a lot of challenges, a couple of years later when the rates went up.
Yeah. Well, we'll dive into that because we definitely want to talk mortgages today. But before we do, I want to get into Dan Patton's story. Like, who is Dan? What was it like growing up in the Patton household? How did you get into mortgages? Why mortgages? It's like, break that down for me.
Well, I appreciate the question. I don't often get asked this in the mortgage world. Normally it's about interest rates and what term do I choose and penalties and all that. So
I want people to know that you're a real person.
Well, I am. Born and raised in Mississauga.
Yeah.
Never really knew what I wanted to do, with my career. I wasn't the best student. I had ADD. At a young age. So I struggled a lot with ADD and focusing and taking direction from teachers.
Yeah.
So I struggled to find a place to fit in, I think, as a youngster. So I found a lot of love with sports. I played hockey. I played baseball. Made a lot of good friends there. I was always big in terms of size. I always was bigger than everybody. So at a young age, that translates well in sports. Baseball, I could hit the ball farther than a lot of kids. And hockey, I could hold the bodies off in a sense with bigger size. So those things played to my advantage, and I found myself more popular in sports than I was at school. So I gravitated more towards sports.
Were you like a straight C, D student, just like get the work done and I'm out?
It was always like if I like anybody, or most people, if I applied myself, I was successful, but I had a real hard time focusing, right? I had a hard time sitting and listening to the teacher talk. I'd get distracted. I'd want to talk to Q. I'd say, want to laugh. I'd want to make jokes. So most of my report cards was he's got it, but he's not applying himself. And he's easily distracted, and he's getting into trouble, and he talks back. And it's interesting because I've always sort of thought that ADD, although at an early age seems like quite a disadvantage, you spend a lot of time when you have ADD. You spend a lot of time being told, "Don't do this, don't do that." Slow down here, stop doing that. Like you feel like you're constantly under attack. And on some levels you develop a sensitivity, I think, to people. You start to learn how to read their facial expressions or their body language to determine, are they mad at me? Am I okay? Am I upsetting anybody right now? You develop these sensitivities, which later in life in sales and what I do now, I think are a huge advantage because I'm able to in a lot of ways read the room. I can read the energy of people, and I think that just comes from a sensitivity to having ADD.
Right. Yeah. My daughter diagnosed me with ADD. I'm like, you sure I got it? She goes, Dad, you definitely got it. But you're right though, because you want to read the room more. You want to make sure, have I offended anybody? And you're making sure that you get a good grasp on that person. Like you're looking at body language. Are they folding their arm? Am I coming on too strong?
Are they looking you in the eye? Are they looking off and thinking about other things? Are they looking at their phone? You develop the sensitivity to it. So
do you find that you got distracted a lot though?
I was, I hated math. It's funny, I'm in mortgages. I hated math. It's
Really?
just, yeah.
Okay.
Yeah, the argument, I always had a calculator at the time back then, and the teachers would always say, well, you have to learn how to do the formulas on your own. And I was like, well, I'll always have a calculator with me. That was my argument.
Right.
Teachers say, well, you won't always have a calculator. Now we have cell phones, we have a calculator. So I like to say to my grade 3 teacher, well, I was right, I have a calculator.
Yeah.
But no, it was the numbers. It was just sitting and focusing. That I struggled with in sitting in classroom settings. So it led me to sports. I think sports is where I met Dave Butler. For those that don't know, Dave Butler is my best friend, my business partner. I've known him for 30 plus years now. We've been tight, and Dave and I met through hockey, and instantly we clicked. Dave was always somebody that was very business orientated. Dave was always coming up with ideas for us to run a business. Well, let's do this and let's do that. And, we had I don't know, I should say this. We had a little bit of a bookie operation when we were younger, believe it or not. Dave was like, we'll take bets from people. The house always wins. We'll take the bets. And, so Dave was always very business minded. So I gravitated towards that because, I think for me, I'm somebody that I like people. I like talking to people. I like doing the sales side of things. And Dave's really good at sales, don't get me wrong, but where Dave really shines is on business development and implementation. It's one thing to come up with the idea of something, but it's another thing to actually do it and implement it, and things like newsletters and things like that. So Dave in the background has always been like that. So I always just believe that, give Dave a lot of credit. If I stick with Dave, he's going to come up, he's going to be a difference maker in a lot of different businesses. And he's going to need somebody like me to be by his side, to be loyal, to, work in sales, to handle the clients. I just always knew that. And, that's a journey that started 20 years ago. When I was in school, like I said, I was a bad student. That sort of led to a little bit of trouble when I was younger.
Yeah.
Went through a little bit of, just say some trouble, nothing crazy, but, a couple run-ins, so to speak.
Okay.
And that set me on a different path. I actually thought after that, I wanted to be a police officer. So while I was applying to be a police officer, I went to school for it. I really changed my sort of direction and said, I want to do this.
Right. So was it one of those things where you're like, man, if you can just get me out of this situation, God, like I'm going to straighten up?
Yeah, it wasn't like that. I don't want to make it seem like it was anything crazy. We were just, back then you're getting into fights maybe, or, things like that at parties. And you're just, I don't think I was really, I didn't have any direction. I really didn't know what I wanted to do. So I figured I'd go into policing. I liked the idea of that. I went to school for it. I was applying. And while I was applying, Dave started in mortgages.
Now, when you say that you didn't have any direction, what was it like growing up in the Patton household? Was your mom there and your dad
Amazing.
there?
Yep. Both my mom and dad were there.
Okay.
I heard somebody say you go through 3 phases with your dad. And I thought that was really, really interesting. They said the first phase is you idolize your dad. Mm-hmm. The second phase is you villainize your dad.
Yeah.
And the third phase is you humanize your dad. Mm. So I think that, that might reign true to me. My dad and my mom have always been my biggest supporters. Like I'm very close with my mom and dad. But there was a time in my middle to late teens where we just didn't see eye to eye. They had a vision and a direction of where they thought I should be. And me being the arrogant teenager that I was, thought I had it all figured out and decided I didn't want to listen to their rules and their direction. And, that put me out of the house a little bit earlier than maybe most people would have been. And, but they were great. They were always supportive. I think, like I said, you humanize them. You realize that your parents aren't these perfect, people. They have flaws and they may make, mistakes. I'm not saying that they did, but it was challenging. And we sort of came back in my mid-20s. We not reconnected because we always stayed in touch, but we just grew a lot closer in my mid-20s. I'm in my mid-40s now, so that was about 20 years ago. So once I found that direction of mortgages and going with Dave, my life really changed. It really did. I found something I loved doing. I knew I never wanted to work for anybody.
Right.
I wanted to work for myself. I wanted to be independent. I wanted to rely on myself. So once I kind of found the ability to do that, it was great. And that was literally 20 years ago. That's how I got into mortgages.
So then what was the name of the mortgage company that you guys first started? And it was a franchised one, correct?
So Dave, back in it got to be 2003, maybe earlier, Dave won Dave got into mortgages. His dad was in mortgages. Dave got in and won a big award. He started out at a company called Mortgage Intelligence.
Okay.
And Mortgage Intelligence at the time was one of the biggest brokerages around, kind of like a Remax or like a Sutton Group might be.
Yeah.
And he won Rookie of the Year across Canada for the amount of volume he did. You know, Dave was just always aggressive. Dave in the first year would go to some of the biggest real estate agents alone as a 19-year-old kid saying, I want your business. And to me, that was like, man, these are people that have been doing it for 20 years. How are you going to get them to send your business? But he had no fear. It was admirable. He didn't care. He'd sit down with anybody.
Right.
So it wasn't a surprise, the success. And, you know, Dave, as a compliment, has a way of making it seem easy. You know, all you got to do is do this, and all you just have to go and see the people. And it's true. You know, on some level, you have to believe. I think his message is you have to believe in yourself. You just have to
100%. And you know, the thing we were talking about this a bit earlier as well too is that when you're in business, when I was working at TD Bank, what you did to have success when you were doing those account management relationship was relationship.
Yeah.
And if people liked you, then they wanted to do business with you. Even if it was more expensive to work with you, they just liked you. And that was an important thing. And I think that's what Dave brought to the table of his likability, the hard work that he would put in, you know, and I'm sure the same with you as well too.
Well, you know, it's in our world of mortgages, you have to be good at two things that are oftentimes individual to people. So what I mean by that is in mortgages, you have to be a natural salesman. You have to be a person, people, because you have to generate sales. You know, you have to meet with big realtors like you. You have to take care of people. You have to find a way to connect with people. But at the same time, you also have to be really good with numbers. You have to be really good at math, and you have to be very analytical, very organized, very good with documents. And just like some realtors, they may be really good at the sales, the back end stuff might be where they suffer. So in mortgages, understanding numbers and math, even though I said I hated it before, that's a huge part of what we do. And that was where I noticed right away where Dave was always really good with math, like really, really good with math. Always, it was like a second thing for him, and always good with sales. So I figured, okay, I'm good at sales. I figured I always was good with people. I could talk to people. If I can just understand the underwriting, if I can get the math down and really focus, then I'll be like Dave. I'll be a strong mortgage agent, and I'll be able to get business.
Right. And so was it just the two of you then in the beginning?
Yeah. So Dave had already, by the time I joined a year later, Dave had already had one assistant, and then I joined basically on like a straight commission. There was no salary. Dave had been sort of at me for a little bit, you know, you should get into mortgages, come to it, sales. And I would say, well, what's a mortgage? I don't even know what I'm selling. We sell money. That's what he said. We sell money. Everybody needs money. So I was like, okay, yeah, I get that. So, you know, to his credit, I was working in bars at the time. I was bartending, trying to apply to be a police officer. Wasn't having a ton of success there just because the process can be pretty arduous. Like it can take, in some cases, years back then before you got hired. So I was going through the process, and Dave was like, come and do mortgages. My dad always said to me, you know, you'd be great in sales. You know, why limit yourself? My dad would always say, you don't want to be a police officer. It's such a tough life. You know, all the respect to police officers, but it's a different life. You deal with the different side of society. Right.
Yeah. And legitimately, somebody might want to take a shot at you.
Yeah,
like,
right.
Or like bullets flying at you.
Like real bullets, not just like I hate your paperwork.
Like I want you dead.
Yeah, right. So you know, I decided, okay, well, I'll apply myself. I'll work at Dave's office 2-3 times a week during the day. I'll bartend at night. I'll see if I can make a little bit of money doing mortgages and try to figure it out. And as I was working with Dave, one of the first weeks I was working with him, one of the things we used to do, or he did, was unaddressed ad mail. And that was when you would mail bulk mail. Everybody probably hates getting it, but it worked. We would mail unaddressed mail to a certain targeted area, by postal code. We would get the flyers printed. We'd have to go pick them up at the printer shop and then drop them off at Canada Post. So one of the first weeks I was there, Dave said, can you go, I got work to do. Can you go pick up the pamphlets from the printer? I'm like, yeah, no problem. I go over, pick up the thing. The guy at there is like, hey, I saw your pamphlet. I need a mortgage. I was like, perfect. That's what I do. I do mortgages. He's like, I want to refinance, and I had no idea what he was talking. I just like, fake until you make it. I was like, okay, yeah, no problem. Let me get back to the office. Let me get your info. Give me your name and number. Let me get back to the office, and I'll give you a call and see what I can do for you. And race back and told Dave, I got this guy. I don't know what to ask him. Dave gave me a list of questions, get his name, get his birthday, like get all this stuff. Right. And, that was my first deal. I closed a deal for that guy, made decent. I made more on that deal than I think I probably made over like a month or two of working in restaurants.
Right. And you're like, I got something.
It just started to make sense. It's like, if I put in the time here that I'm putting in at restaurants, I'll probably make more money doing this. And I figured the only way to test myself was to cut out the restaurant part and
just go right in full time. And I think that's the way to do it, right? You just got to get right into it. And so from there, then now it's just the two of you guys. And then you grew it. What was the height of the, would you say, of the business? How many people did you guys have working with you? Because then you moved from Mortgage Intelligence over into Better Mortgage Select, which you guys are doing today.
So Dave and I always had separate businesses, right? So despite us working together, he had his book of business and I had my book of business. And one of the things he really focused on was investors, as you know.
Yeah.
And as the investor base grew, he needed help. He needed help on that side of the business. So I'd say somewhere around 2015 is probably when I joined with him in that sense of like, okay, let's combine our businesses. Let's combine the volume. The idea at the time, which is how we sort of built our model different than others, is the idea at the time was, okay, Dave's really good at the numbers and Dave didn't want to do sales at the time. Dave had been burnt out, sales, staying up till 4 a.m, calls. Like, he was just burnt out. He wanted to do the underwriting. That was music to my ears because I didn't want to do the underwriting. I just wanted to do the sales. I said, Dave, if you do the underwriting and you tell me what the people are approved for, I'll go tell the clients and I'll do all of that and you do the back end.
Yeah. And that's a great business partnership, is when you guys can complement each other. Like, you're strong in this aspect of the business and he's strong in that aspect, and you guys come together. It's like a yin and a yang.
Yeah. And that was really, I think, what was the basis of building our business. Because from there, you're right, we started to scale up. I mean, from 2015 to 2019 was still pretty busy. I mean, Dave and I, even in the small crash in 2008, we didn't feel it as from business wise. Like, we just kept on an upward trajectory for about 20 years. Everything was just going upward. And then you hit.
And the great thing about that as well too is, and why I think you guys had so much success, was because you weren't only just working with first-time home buyers or people buying their home for their own personal use, but the investors.
Yeah.
Because they would buy 2, 3, maybe 4 properties in a year. And that was huge.
Yeah, investors were, we knew, we sort of recognized early on that investors were a great investment for us because simple as that, right? Lots of deals going on. Not only lots of deals, but it's difficult. We've talked about this before. It's difficult for investors to get financing, especially when they have multiple properties. So I think in any business, if you can find a problem in that market and identify a solution, which for us was, well, how do all these investors figure out a place to go to scale their portfolio? Because if you go to BMO, you're only going to get BMO answers. If you go to RBC, now you could take the time to go to each individual bank, figure out their underwriting and figure out how many properties you're going to buy. And that's going to take a hell of a lot of time and a lot of training and a lot. So we just recognized early on that would be something valuable to investors, and real estate investing, I mean, went crazy. It was very popular, so it was just a natural, it was a great progression, partnering with investors, working with first-time home buyers. We in the peak, so the business was going great. COVID hit initially, and that was sort of our first sign of like, holy cow, what's about to happen? Because if you remember,
we didn't know. Nobody knew, because it was like, okay, this is it. This is where the crash happened.
This is it.
I don't know if you remember that we went to the Raptors game with you guys in the box.
Did we?
That was right before the announcement. Because I remember looking back the week after saying, man, I was on a packed GO train going down. I hope I'm okay, And it literally was like a couple weeks after that.
So then that was out. What then? Early March, I guess, or something like that, of 2020.
Yeah, I think
right before the lockdown.
It was before. It wasn't even announced yet. It was just rumblings that were sort of speculating into our parts, and it would have been late February, I think.
Yeah, because the big thing then, I was in Jamaica end of February, and it was Kobe's death. That was a big thing.
Yeah,
It wasn't so much COVID. We heard about COVID, like, it's probably gonna be like another SARS, no big deal, right?
We if you remember when it first hit, the idea of we don't even know if you can get appraisals in the house, because back then they weren't doing a lot of automated appraisals like they are now. So that alone, when you had deals closing and everything shut down, and you couldn't have, at the snap of a finger, you couldn't have appraisers going into the house that's closing in like a month. How do you fix? So there was a lot of panic that set in. Now, the reality was the banks adjusted, the rates came down, and we all know what happened with the market. The market went stupid. And
that's when everybody wanted to be an investor. And so we're going to get into all that as well too, where we are in the market today. But then you got to, how many people would you say at the peak that you guys got up
50.
to?
50 staff.
So you guys got, okay. And so where are you sitting today?
We're about 19 now.
19,
you know, again, one of the challenges with scaling and being busy was when you get to a point where you're just so busy, you tend to just, and listen, in a world where the business is successful and money is coming in, it's very easy to mask problems with putting money at the problem. So if I don't have time, I might just hire you to come in and take time and free up time. And now you say you're too busy and I don't have time to really look into it, but you say you need an assistant. So, okay, now I got to go hire an assistant for you because you're overworked. You end up at the time, one of the things COVID helped us with was we were able to relook at our entire business model, you know, which we had to. I think a lot of businesses did. It was an opportunity to change things because we had ballooned, like I said, up to 50 people in the peak. 50 people at a mortgage office is insane. It's crazy. I would literally be on team meetings being like, I can't believe there's 50 people in here. So we scaled back. We unfortunately, you know, cut some departments that didn't necessarily need to be there. We reworked the role of a lot of the people, including the sales team, changed the job and trimmed us down to, I think we're at 18 or 19 now, and it's by far the best we've ever been. Like, this is, right now I have the best team that we've ever had. We're built to succeed. We're built for volume. We're built for knowledge. Like the back end, to give Lorenzo a lot of credit, you know, you guys know Lorenzo. Lorenzo really took the reins from Dave. Dave was great, but Lorenzo really implemented the back end structure to our business. And that's so important because we always had the sales. We were always good at bringing in the business, but learning the back end and keeping up with the different bank products, the different bank programs, how to get approved. That's a huge part of it. And that was a lot of Lorenzo.
That's awesome. So listen, thanks for the backstory. Thanks for, you know, sharing that with us. And now I want to dive into where things are in the market. And, you know, there's been a lot of changes, a lot of updates happening. And so where's mortgage rates right now? And then I also want to dive into some of the new products that are out there right now with where things are in the market.
Well, I mean, gosh, it's we're July 3rd today, right? I want to date this because people listened to it 6 months ago. Oh, he's way off
July
on rates,
3rd. Yeah, and I think it's going to be released next week anyway, so maybe like July 10th or something like that. Or earlier.
Yeah, I think most variables. I mean, look, if you're talking conventional, you're going to be somewhere around 4.5% on a variable, maybe a little bit lower.
Is that for a homeowner or is that for an investor? Because the investor's interest rates are typically a bit higher, right?
Yeah, depending on the lender. You know, some banks. This is where rates is. It's not that I'm avoiding the question, but rates can vary. You know, at one bank, they may not have a difference. If you're buying a rental or an owner occupied, it could be the same rate. Other banks don't offer a discount on rental, and some banks do offer a discount on rental. So, so if you want a range of rates, you're probably 4.5% to 5% on rentals or owner occupieds. Okay. But there are some lenders that'll do around 4.5% on rentals as well.
Anything below 4s?
Yeah, you can get a 3-year owner occupieds. You know, it's funny, you know, we've sort of been advising, you know, in my world, if I can take a 5-year right now, I would prefer a 5-year because I'm just not sure where rates are going to be in 3 years. And people ask me why. And the reason is I'm not sure where inflation's going to go. You know, we're in a time right now where most people believe interest rates are set to come down. Variable rate, we don't know about fixed rate, but variable rate's going to come down.
Right.
And what will that do to the economy? Well, look what happened in COVID when we dropped rates. And I'm not suggesting we're going to drop them as fast and as quick as we did, or they're going to get to as low as they did. But if we drop rates too fast, or if rates come down too much, it could lead to spiked inflation in 2 to 3 years. So I don't know. I'm not saying it's a bad idea. I just don't know that I want to renew in 3 years from now. So I'm sort of favoring a 5-year. But what's interesting is the 5-year is higher than the 3-year. You know, you're going to get a 5-year fixed rate these days around You might get 3.99 on a renewal, but like new business, a purchase or a refinance, like a restructuring, you might be like 4.09 to 4.25 on an owner occupied, maybe a little higher on a rental, something like that.
Yeah. So now you're touching on inflation as well too. What's the difference between headline inflation and core inflation?
Yeah, so core inflation basically measures the things we can control. Headline inflation measures things like gas and energy as well, right?
Okay.
And we don't have necessarily control over those costs. So it's interesting though, because core inflation, the Bank of Canada said we have to pay attention to headline inflation. And when headline inflation gets down to 2%, that's when we'll start to see the ease of interest rates.
Right.
So we saw headline inflation come down to 2%.
Yep.
We saw interest rates come down, and now we see headline inflation under 2%. And that's causing some people to think, well, rates will come down. Headline inflation's down. Inflation is low. We want some relative inflation because it means the economy is growing, at a steady pace.
Right.
So, what's interesting is we can sort of tell they're not paying attention to headline inflation right now. They're looking at core inflation because core inflation right now is trending upwards over the last couple months.
What are we at right now? Do you know?
Oh, I'd have to look it up. I think core inflation, I don't know if you could pull it up now.
Yeah, I think headline inflation was 1.7.
Yeah, headline inflation.
Core inflation is sitting at about 3.15. That's when you did your last webinar. That's the numbers that I got, right, Q?
Yeah, that sounds right.
Yeah, so there you go. So that's just an indication that it's really not headline inflation that's the driving force for the Bank of Canada's movement on rates. It's more core inflation.
Right.
Now, again, people will say, well, core inflation's up because inflation is up and costs are up. But I would expect core inflation to fall over the next few months. I think that's just natural.
Yeah. And so based on that, where are you seeing, this is probably the big question now with the Bank of Canada. You're hearing a lot of people talk about that they're going to lower maybe 2 more times this year. Are you on that same line of thinking?
I think 1 to 2 more times. I did an event with you guys a few weeks ago where I said the same thing. I'd be shocked if we saw a drop in July. I think we're probably going to see 1, maybe 2 by the end of the year.
Yeah.
How many more meetings do we have? 4?
Yeah, I think so.
4 more meetings. So, 2 would be a lot. 2 would be a lot, but I think it's coming. Our GDP underperformed. The economy is not growing at the pace we want it to.
Yeah.
I think we're definitely going to see rate cuts on variable. Quarter point, half a point. I'd love to think I'm the one who studies all the info, but I just follow the economists. I read what the BMO economist and what the CIBC and what the Scotia, I read what the economists say. And most of them, some are less optimistic. They think interest rates, if you look at the Scotia economist, I think it was, the Scotia economist said he thinks no more drops for the rest of the year. The BMO economist, Lorenzo and I went to an event a couple months ago, and the BMO economist said you can expect maybe 2 to 3 drops this year. So, if you look at sort of the average, the truth is probably somewhere in the middle. So you got one guy saying none, one guy saying 75. So that leads me somewhere between 25.
But are they
and
coming
50.
up with something to say that on both of those sides of the spectrum? Meaning, there's been this talk of a tidal wave of people that now are going to be coming up for renewal who had interest rates sitting at 1.5%, 2%. They're now going to be at that 4.25%, 4.5%.
Yeah.
Right?
Yeah. But, that's not as much of a fear when you're going from, you're right. Listen, a large part of renewals is happening this year and next year. That was a big concern.
Yeah.
And that was a big concern last year and the year before because people had 6% interest rates. That's what you were getting offered. So when you're taking maybe you had a 2.5% fixed rate and now you have to renew it at 6.5%, that's a massive difference to your cash flow. So yes, it's still a difference now when you're going from 2.5% to 3.5% or 4%, like I said earlier, but there's things you can do to control that payment. You can push out amortization on renewals, so I guess if you're asking me, is that a big concern? Yes, it's on the forefront of the bank's mind as these renewals coming up, but I don't think they're going to adjust interest rates to accommodate the renewals.
Right.
You know what I mean?
Yeah.
defaults are up in younger people, but I don't think they're necessarily up. I think I read a thing this morning that said the younger generation's defaults are up. It was a guy from TransUnion. I can't remember.
But it's still pretty low though. If you take,
in Canada, the default rate's very low.
Like what were we on average, say prior to where we are now? Like what we were like under 1%, like 0.5, maybe.
Always under 1, and that's the problem. They're so low. So if there's a spike,
that's true.
50% increase in defaults, right?
Yeah,
the sample size is so
they look
small.
for trends. Right. So the trend is, you see younger people are defaulting. Well, why are younger people defaulting? Well, younger people maybe bought at the peak and now interest rates have gone up and they don't necessarily have the backup or the income structure or the amortization schedule in their mortgage to be able to.
And the equity.
That's what I mean. I mean, I think that the market is still like, I don't know, what are you guys seeing? I think the market is still strong. It's shifted from a seller's market to more of a balanced market. I don't know that I'd say it's a buyer's market, but I think it just seems more balanced.
Well, being on the streets, I would say it's definitely more of a buyer's market, especially in the condo space. 100%, it's a buyer's market.
Yeah, it's a tale of different markets, neighborhoods. You got to get really micro to understand what's going on in different neighborhoods. And obviously, we know condos. That's a whole different discussion than the housing market. Right?
Yeah, when you get into like the townhomes or the starter homes, you're still seeing some multiple offers, and then when you start getting over $1 million, right, Q, you're seeing those homes sit longer. And and here's the thing though, is that people say, "Oh my God, the home's been sitting there for like 30 days." That's not that long.
Yeah.
You know what I mean? For people to make a decision on whether or not they should go this one or that one. So it does give people time to go out, shop more. That's what you're seeing now. There's a lot more people are taking their time. They're shopping around. They're not in a hurry. They can put in all their conditions. This is a better climate to be working in. It's a much better climate.
You're getting less showings on your listings, but everyone coming through is a serious buyer.
Yeah.
Right?
Yeah.
There's no looky-loos. And when the peak of the market, everyone's, I think I'm going to buy a house. And there are hundreds of people going through your house over a weekend. Right?
I would also say, too, that what I was surprised with is that there was a lot more real estate investors in the market than I think I had realized. I knew there was a lot, but it was a lot more.
Yeah.
A lot of accidental landlords as well, too. And you can see that like in the conversations that we're having, the phone calls that we're making, right?
Do your clients think about the inventory in 28, 29? Because one of the interesting things that's sort of looming in the future is there's buildings and developments going on now, but a lot of those are stopping going forward. So you're going to have much less developments, much less property in 2028, 2029, which could again flip the script back to a seller's market, right? If the inventory is not there. I mean, it's all about supply and demand.
Yeah, I believe so as well too. Like I think right now we're going to probably be in a lull for the next maybe 3 to 5 years where you might get a little bit of an increase, maybe you get a little bit of, so you're going to be in that little lull. And then I think all of a sudden, maybe like, 2028, 2029, not so much in the condo market. I think that might be a lost decade. I believe so. But I think in the freehold, I think you're going to see all of a sudden now where these new homes haven't been built, you're going to now see a huge demand.
Yeah.
And especially now, like in Toronto, there's such a great opportunity to be buying in that particular market right now in a major city.
Yeah.
To pick up detached homes for 800, 900,000, and the city and the government have gone ahead and upzoned that land for you. That is huge. Yeah. You can buy it at a single family home price that you can convert into like a 5 or a 6 unit. That's massive.
Yeah, it's it's funny you say that because you're right. One of the things for investors nowadays is you're right. There's probably not as many investors buying, but there's certainly a lot of investors that are still property owners. Yep. And a lot of those people who bought in 2020, 2021, even 2022 could be finding themselves in cash flow negative positions right now just because of costs and interest rates. So people are looking for ways to turn those properties into cash flow positive properties when they're out buying. When you're an investor, the days of buying a single family rental, renting it to a family and being cash flow positive is almost disappeared.
The good old days. Yeah, that's when we were in it, man.
I say almost because I know Qs can find them. I say almost because I know, but so investors, real estate investing has never been easy. Okay. There's always risk. There's always work. It looked easy from 2020 to 2022 because everything you bought went up 20% per year. It was up 3 months after you bought it. You could have sold it and make money. So real estate seemed easy. It was an illusion. The reality is real estate is work, and it takes time and it takes patience. So what are people doing these days? Well, they're looking for ways to take their single family homes and add garden suites, add ADUs, find ways to make it cash flow positive, because that is when you look at living and you look at lifestyle, that's a huge future of living, is like legacy homes, right? Where you have families staying in one home, and then, my son's going to live in, we're going to rent this ADU for a while, and then maybe my son will live in the ADU when he's old enough, rather than move out for affordability.
So where are you going with this, Dan? Is there a new product you're lining up here?
Well, it's funny you say, Gary. You're very astute. No, it's one of the things we've, at BM Select, we've really tried to stay on top of is the products that are out there for investors. So, one of the things we can talk about is we've developed sort of 3 different programs. We call it the BM Select Investor Edge, where we have the Build Up program, which is a construction program we can talk about, where you can buy a home, you can finance the construction of a new home, the tear down and build of a new home, or the addition of an ADU. You can take an existing house and do the same with this program. So it's the Build Up. We have the Scale Up, which is we've partnered with a bank that'll allow up to 40 rentals, on your application, 40 doors. That's new. Most banks these days, if you're working with a bank and you're trying to buy investment properties, you may only have a max amount of 5 or 10, right? Most banks have a limit or a cap on how many properties you can own. Some of them have a cap on how many you can own total, not even if you have mortgages with them. So having the opportunity to go to a lender where you can scale up to 40 doors using a DCR, a DCR is a debt coverage ratio. This is a alternate to your typical TDS. A TDS qualification is when you're an investor trying to borrow money from the bank. Very simply, the bank's looking at 3 things to qualify you, right? I want to borrow money from the bank. The bank says, okay, you have to go 3 for 3 on these criteria. 1, you got to have the minimum down payment. It's got to be coming from an acceptable source. So that's an easy one for clients, right? Okay, I got the 20%. It's coming from my HELOC. Okay, great. 2, you have to have good credit. 3, you have to have your debt service in line, your income. And that's why a lot of clients, depending on if they're retired or self-employed or have other properties, they may run into a debt service issue because the bank is looking at their monthly income in terms of their employment, and then they're looking at their monthly debt in terms of their mortgages and all of that.
And what are those rates need to be for somebody who's listening and they don't know?
Well, there's a standard number. They want a TDS of 44%, and that's basically your monthly income divided by your monthly debt. But where it varies is how a bank calculates your monthly income versus your debt. Some banks will count rental income differently than other banks. Some banks will count HELOC limits different than others. But general is they all want you to be at about a 44% TDS. So why is this Scale Up program is exciting is because it takes that all away. They don't care about your personal TDS. A DCR program more looks at the rental portfolio as a qualification. Does your portfolio cash flow as a whole? And if it does, they don't care about your debt service. They're looking at a DCR. So it's a good alternative. It's a really good alternative to anybody that's been struggling to qualify through the traditional, TDS ways, which is how most banks do it. That's how all the big banks do it.
So can you break down that product a little bit more in regards to if I own a home, now I want to build a garden suite in the back, is there a certain amount of money that I've got to come up with? How do they calculate that?
So the Build Up program that we offer is, imagine, let's just say you're trying to buy a home for $1 million. Let's just use that easy numbers, okay? So you want to buy a home for $1 million, and then you want to add a $300,000 ADU to that property. Okay. You have to have the down payment on the $1 million home. So you're buying $1 million, 20% down, you got to have the $200K. Then you have to have the contractor quotes for the work that has to be done. Let's assume those contractor quotes, are for $300,000. Okay. So the bank will then say to you, okay, we are going to appraise the property as is today. We bought it at $1 million. We're going to appraise it at the property value today. And then we're also going to appraise it at the as is value, or as if value, I should say. You give me the contractor quotes and the appraiser will give you the as if value. If the as if value, if we just say it's dollar for dollar and the after reno value is going to be 1.3 million, the bank will approve that loan up front up to 80% of the 1.3 million. Okay.
Got it. Yep.
So they've approved you. They've given you a rate hold. And now it's time to start it's closing date, and you want to start the project. The money is released to you in this way. You bought at $1 million. You put 20% down. You're going to borrow that $800,000. Pretty good rate. It's like half a point higher than a HELOC. It's like 6 to 6.09%. You're borrowing that $800,000 at 6%, 6.09% interest only payments right now.
Hold on, the full mortgage amount.
The mortgage amount, because you're buying it under this construction program.
Got
that
it.
Original
okay, so you're not
$800,000.
getting it at your 4.5%.
Correct.
You're getting it at a higher rate, the full amount.
Correct.
Interest only.
Interest only.
So, yep.
So the payment may not be more, but you're bang on. It's more interest. So you're paying interest only on that $800,000. Now the bank, because we got approved on this $300,000 ADU, they want us to have 15% of that $300,000 to start the project.
So what are we looking at? About $45,000.
$45,000. We got to have $45,000 on hand. That $45,000 can come from a HELOC. It can come from a gift from family. There's lots of different ways for us to source.
Interesting.
It. Right.
Okay.
So we now start the project. Now, again, at this point, the bank has approved our $300,000. They've come up with some sort of a draw structure. Let's assume the draw structure is 4 draws at $75K each. That equals $300,000.
Right.
Okay. So we now start the project with our 15% that we have, our 45 grand. We have to get to the completion percentage that the bank outlined in the original agreement, right? Let's get it to 16, 17, 20% complete, whatever it is. And then we'll start the draws. So you fund and get it to the completion percentage to start. Now remember, you're still paying interest only on that original 800,000. Okay. First draw comes in 75 grand. You're paying 6.09% interest only on that 75 grand. Hit the next milestone, the next 75 grand gets and so on until all the draws.
Can you just calculate that for me? I just want to know what that 800,000 looks like on interest of 6%.
So you're going to be about, if you just do the quick math, you're going to be about $450 times 8. Oh, sorry. No, it's going to be a little higher. Try like maybe 500. You might want to do it on your computer.
6% flat?
Yeah, 6% is how much?
Yeah.
Four a month.
Yeah.
So 400 a month?
No, 4K.
4K a month.
Yeah.
Okay.
Yeah.
Okay.
Interest only. That's
Interest
about right.
only. Yeah.
Yep.
Yeah, interest only. So 4K. Okay, so then now you get the 300. Now you're not getting the full 3. You're getting 75,000
That's
your
right.
first draw.
Yep.
That then gets added to that 800K.
Correct.
At the 6%.
Yep.
Okay, got it.
Interest only. And same thing through the other draws.
Okay.
Once the project is completed, the banks typically want you to have 6 months to a year to complete the project, not much longer than that. And it'd be hard to get longer. And once the project is completed, the entire loan is now moved into the original mortgage you were approved for. So if you were approved for the 80% of the 1.3 million, you're going to be approved for what's that, $1,040,000. Your everything will be now consolidated at the end at the interest rate you were approved for at the beginning.
And it amortized over 30 years.
Yeah. Standard mortgage, just turns right into a mortgage.
Now, and you can also do that under the MLI Select program as well?
No, this is residential only. So this is a fully qualified residential program. This doesn't apply to commercial MLI.
So even if I turn it into a 5-unit, I still couldn't do it.
Couldn't work. Got 4 units at the max on this program.
Interesting.
That's something maybe down the road you refinance into that. The question, first of all, when you dropped that on the webinar in June, it was like, I had to call Gary. I said, oh my God, this is amazing. These guys are so progressive. And this is what we need in the investor community right now, because we know this market is for savvy investors, right? Yep. My question in regards to that program, then I'm here, I'm in my second year of my 3-year mortgage right now. I know I want to do a garden suite. So would I just wait for maturity and then say, hey, Dan, get me in with your lender to get this project going?
So very good question. So the example I gave you was on a purchase. So let's talk about a refinance. If you have a property, let's say it's the same property, it's valued at $1 million. You have a mortgage on it of, let's say, listen, this program, if you can self-finance the build. So the reason why I'm just sort of sidetracked for a second is if you have $1 million home and you have a $500,000 mortgage balance on it, the easiest answer for me to fund that project of $300K would be to maybe get a HELOC on your house and have you self-finance it. Okay. Right. If you can self-finance it, that's the best. That's the cheapest way you're going to do it. You get a HELOC, something like that, self-finance it. If there's not enough equity in the home, or you don't have the capital to do it, then this is where the refinance might work, right? So imagine you have a house, same thing, and bought it for $1 million. You owe $750 on it right now, okay? And you want to add a $300,000 ADU to this property. Well, the same thing's going to apply. You go through the application, right? You qualify. We do the appraisal, the as is and the as if. And if we get the approval, we would then move that $750,000 mortgage over to the new lender, and that $750,000 would start at that 6.09% interest only. Same thing though, you're getting approved for the final product at the time, that end of the line sort of mortgage approval on the 1.3 million, but they're going to take over the existing mortgage of $750,000, and then they're going to, got to have the 15% for the draws, do the get the draws back and then refinance at the end. So it works very similarly. You can do it if you have an existing home, and that's for anybody that bought in 2020, later 2022 till like 2025. If you bought an investment property and it's not cash flowing, that's the a big target audience, because those are the people that maybe don't have the equity to do it. They don't have the cash on hand to do it, but they're trying to find a way to convert their single family home into a multi-family rental to get the cash flow up.
All right, Q. So get on the phone right after this here and start calling everybody.
No, it's a no-brainer.
But it's such a great product, because there are so many real estate investors right now that are in that situation where they don't have the cash flow. The interest rates just shot up on them, and they need something like this. So I think it's a great product.
Yeah, and it's cheaper. Like, most of the time, if you can't self-finance it, you're looking at some sort of private funding for this, and private money on this comes expensive. You're talking
as long as they didn't buy a condo.
As long as they bought a condo.
There's no garden suite going in your condo. No, sorry.
Now, speaking of condos and getting into like the pre-construction, what are you seeing in that space right now with people who bought in, say, 2021 or 2022, and now they're closing? Yeah. What are you seeing there?
More problems than I think we've ever seen on new cons, definitely. And big reason is appraisals. That's the biggest problem, right? You bought a house 2 years ago. There was a time, as you guys I'm sure remember, where if you buy new construction, it's going to go up in value. 3 years later, it's up, 100, 200 grand more. But that's just not the case now. So we spend a lot of time working with clients these days who maybe bought a property and are now having trouble closing it because the appraisal's coming in low, or maybe they can't qualify. So the condo market is, for anybody that bought the new build, that would be my biggest flag, is the appraisal for sure.
What are you seeing that they're doing? Are they walking away?
Some are forced to walk away. I mean, and something like that, I would certainly suggest talking to your lawyer. Your lawyer's going to be the
We are not giving advice to walk away. Just
I'm
make
not
sure.
Because every builder is different, and you could be liable for not just the deposit. You could be liable for other costs. So I would certainly.
They may come after your other assets. Right.
Yeah.
I'm sure those contracts are ironclad.
Well, and we have to find creative ways to get it done. One of the ways, if clients own other properties, sometimes you can draw the shortfall. Because what happens is, maybe people don't know this, but what happens is if you bought a house for $800,000 in 2022 and you have to close on it this year, right? Because the mortgage is coming up, registration's coming up, you have to close at $800,000. Well, what happens when the bank comes in at a $700,000 appraisal? Well, the bank will only ever lend you the lower of the appraised value or the purchase price. That's it. So if you buy a home and it appraises higher, they're only going to lend you based on the purchase price. But if you bought a home and the appraisal's lower, they're only going to lend you on the appraised value. So if you bought at 8 and it's appraising at 7, the bank is only going to finance you 80% on the $700K, which means you're going to be $100K short at closing.
Right.
And you don't know that necessarily, because remember, you're not on a new con. You're not getting the appraisal done until it's completed.
Yeah. And I'm sure a lot of people as well too had no intentions of even closing on these condos,
100%,
right?
man.
So then what are you doing solution based wise? Are you then extracting equity, maybe say from their owner occupied home, or maybe like a rental that they might own?
Yep. Definitely. That's one of the ways.
Any other solutions?
Yeah. Sometimes people aren't aware of this, but and a lot of times when you're buying at 20% down, it requires an appraisal. When you're buying at less than 20% down, it doesn't always require an appraisal. So believe it or not, we've had some luck transitioning from a conventional deal to an insured deal, and avoiding I literally had a deal where the appraiser at 20% down was coming in $150K light, 150. and we converted the great applicants. They qualified. We converted it to an insured deal, and as an insured deal, CMHC signed off on the value right away. No appraisal.
On that point, was that one where they didn't have a 20% deposit down there?
Well, they did. They had the 20% down, but the problem with 20% down was it required an appraisal, and the appraisal was coming in low. So by you're right to think, well, that sounds odd, because by switching it to 19% down, you're now eliminating the need for the appraisal, but you're now insuring your mortgage. So there's a cost to that of having an insured mortgage. But when you're talking to clients who at the time had no ability to come up with that shortfall of funds, this was the perfect solution, because the CMHC premium gets added to the mortgage. So the client didn't have to come up with any money at closing. In fact, because they had given a 20% deposit,
they get a check.
They got money back on closing, right? I mean,
you
they had
mean
a
the
higher
cashback mortgages are back then?
yeah, right. Yeah, exactly. So, creative things like that, it's really unique. In some cases, one appraiser might be 100K light, one appraiser might come in at value. So figuring out which appraisers to use, which banks can you manipulate the appraiser to, no, I don't mean manipulate the appraiser. I just mean get the right appraiser that's on the bank's list to go to the property, right?
Yeah.
Because every bank has an approved list, and most banks now, they don't like it. They don't let me just pick the appraiser. There's a whole third-party system. So you have to try to find ways to get the right appraiser for that bank to the property.
Yeah, that's a good strat. It's very interesting. I never even thought about that before as well, too, right? For a lot of those condo owners that are closing now, because I'm sure most of them put down 10% to 20%.
Yeah, 10,
yeah,
20.
you can scale it back.
Yeah. Well, that's a lot of people don't realize that the deposit isn't the down payment. They're related, but they're not the same thing. You can put 20% down and then buy at 5 or 10% and get money back.
Yeah. Now, I know on your webinar you had mentioned that what was it again? Pre-approvals are up 15%.
Yeah.
Okay.
Yeah.
Are they refinancing? Are they purchasing? What are you seeing happening there?
And sorry, first of all, that was a fantastic stat. That was another one of the nuggets from that webinar, because I was telling you, we see the TREB stats and markets down, sales up, X, Y, and Z. But to hear that those grassroots from your organization was fantastic. So
thanks.
Keep those stats coming.
I appreciate that. Sometimes I think we're a bit skewed because Dave went to a conference not too long ago in Montreal. And was talking to a bunch of other brokers, and across the board, mortgage brokers are down. Unless you're in Quebec or maybe parts of Alberta, business is down. Everybody's getting killed. But we're busy. I mean, we're up. It's a testament to our partners. It's a testament to the team. So hopefully those numbers aren't skewed. But yeah, our pre-approvals are up 15%. I mean, we're seeing a lot more.
And sorry, just clarify for the listeners, that's year over year.
Year over year.
So just
from
so
last
they
year.
understand what.
So we see more applications coming in. We don't necessarily see them transitioning to buying just yet, because I'm sure, as you guys experience, a lot of people think they can time the market or want to try to time the market. So they'll get their ducks in order, but then they want to wait for the bottom of the market, right? Which is always tough to. So I can see the buildup of buyers happening from a frontline level. I think that's the thing. It's like you're up 15%, but they're not necessarily buying.
Right.
You ever go to Vegas and you see that there's one coin machine where it's a ledge and there's probably thousands of dollars of quarters just lined up on the edge. And when you drop one in, it pushes them slightly over and you're just waiting for all of them to fall over the edge. It feels a bit like that for buyers, because I'm seeing that lineup of pre-approvals coming in. The buyers are there. They want to know their numbers because rates are down. They're qualifying for higher numbers. This is the first year we've had 30-year amortizations on insured deals in a long time for first-time home buyers. So you're seeing lower interest rates. You're seeing more client-friendly products to help with affordability, help with qualifying. So it's mixing, but it's not transitioning yet. So what is it? What's stopping people from taking that step? I mean, that's the $1 million question. Right?
Okay, so you don't have the answer for that. They're just But that's an interesting analogy of what is happening, that there's so many approvals that are not approvals, but pre-approvals that are taking place, but they're not diving into the water yet.
Yeah.
Interesting.
Well, I think it goes back. They know they have time. They're really thinking things through thoroughly, right?
Yeah.
With the family,
before you didn't have that
location,
time.
this, that.
Yeah.
Like I said, I find now by the time buyers are going out looking, they've done all this homework. So they've been sitting on the sideline, pre-approval. Okay, this is what we could afford. This pockets, here's the average price. What about over here? We like the school over here.
Yep.
And they're doing more of that legwork up front, right? In terms of interest rates and that, Dan, can we sort of show the contrast between B lenders now? Because, you know, the A box can get a little tighter.
Yep.
But has that gap shrunk between the A and B in terms of rates and
really good
options?
question? So the big difference, right? When you're comparing A lender and B lender, you have to compare the same term. So you can't compare a 1 year with a B lender with a 3 or a 5 year with an A lender. I mean, you can, but you're going to get such a vast difference.
Right.
If you compare a 1 year at a B lender to a 1 year at an A lender, very similar. Maybe quarter point. In some cases, they're even. You know, so interest rate wise, the gap between a B lender and A lender is pretty similar to where it's always been. I mean, B lender is just a little more expensive when it comes to rate, and then of course they have their 1% fee. But it's interesting because B lending is originally it was designed for maybe stressed credit. You know, if you couldn't qualify, that was sort of a place you could go. Self-employed people, if you weren't showing the income, it's a place you can go. Now, again, that's the bulk of what we do. We do some, you know, stress credit scenarios with B lenders, but a lot of ours are investors that are self-employed that don't show enough income. So the argument is always, well, the self-employed guy wants what everybody else wants. Self-employed guy or girl wants what everybody else wants. They want the lowest interest rate, right? They want to save money. That's the key. It's not so much the lowest rate. We just want to save money. Well, we always associate having the lowest rate with saving money because it's just an easy formula to look at. But when you're self-employed and you're looking at somebody who's, if I make $100,000 because I'm self-employed and I write my income down to like 20K, I'm paying very little tax on that money.
Right.
If I'm an employee, if I'm a teacher working and making $100,000, I'm paying a lot of money in taxes. So yes, I'm getting a lower interest rate as a teacher, right? I'm getting a better rate, but am I really saving more money than the self-employed person who has to take maybe, you know, look, if you compare the cost, if you actually did compare a 3-year fixed rate at a bank, let's say it's 4.5%, and a 1 year at a B lender at like 6%, maybe that's roughly what a B lender might be. Depending on the mortgage amount, you could have like, say it's a $300 or $400 a month payment difference. Okay, so $400 a month times 12 is $4,800 a year in extra mortgage payments. Plus, you'd have a 1% lender fee in the first year.
Right.
So if you borrowed $500,000, that's $5,000. You're in total $10K extra to be with the B lender. So that's the biggest argument for a self-employed person to look at a B lender is, look, don't worry about the lowest rate in a sense. Save your money on with the taxes. Don't keep your money for yourself, pay less taxes, and go with the B lender.
Right.
Now that's again, if you're close, if you're on the line of, well, I need to claim 90K and I'm only claiming 60K. Well, then I can coach the client and tell them, well, you got to pay yourself this amount for the next couple of years and I can move you to an A lender. So I can coach the client on getting in with the B lender and then how we're going to get out and go over the numbers of what those costs would be.
Right. Dan, listen, this has been a very interesting conversation. Thanks for sharing your story as well, too. I don't think a lot of people have heard that story and how you and Dave got started in the mortgage business and your ADD and how you've used that now to your strength.
Give thanks to sports, man.
Yeah.
Don't underestimate the power of sports and the life lessons. We all grow up. All three of us here grew up playing, and so many life analogies in sports, man.
Yeah,
100%.
exactly. So, Dan, if anybody wants to get a hold of you and use your services, what's the best way?
Yeah, email info@bmselect.ca. You can email me at daniel@bmselect.ca. Either one, it'll go to me directly.
Yeah, awesome. Q, any last words?
No, just please reach out to your mortgage professional. For us, we know it's Dan. If you need any questions answered, if your renewal is 2 years away, reach out now. Plan, get ahead of it, right? Give us a shout for your financial checkup.
Yeah, and I'll wrap it up with this. As you know, I've been working with Dan and Dave since 2009. I trust these guys, and when it comes to finances, it's probably the most important piece to your home, to your real estate investing needs, and they're one of the best in the industry. So reach out to them. I don't go to anybody else but these guys. So Dan, thank you very much. Thank you for all the help you've done over the years for us and our clients.
Thank you,
and
guys.
We appreciate it.
We love the partnership. You guys have been amazing. So thank you to you. Thank you to Q. Thanks to Chris, Darlene, Catherine, Karen, everybody on the team. We appreciate it.
Awesome. Thanks, Dan. We'll do this again.
Awesome.